There is a ghost in the machine of modern finance. It is a phantom that lives in the glowing screens of cable news networks, in the urgent push notifications on your phone, and in the confident pronouncements of economists who chart the future with the unearned certainty of fortune tellers. This ghost whispers a single, seductive, and ruinously false promise: that the key to building wealth is to correctly predict the future. It tells you that if you can just figure out what the Federal Reserve will do next, who will win the next election, or where the price of oil is headed, you can unlock the cheat codes to the market. And so, millions of investors, from beginners making their first trade to seasoned professionals managing millions in assets, spend their days in a state of perpetual anxiety, their fortunes tethered to the chaotic winds of macroeconomic forecasts. They are players in a game they cannot win, a game rigged not by insiders, but by the very nature of complexity and human fallibility. They are told that their primary job is to be a weather vane, spinning frantically to catch the next shift in the global economic climate. This is the great lie of modern investing. And it is a lie that has cost ordinary people more money, more peace of mind, and more opportunity than any single market crash in history. But far away from this frantic noise, in a quiet office in Omaha, Nebraska, sits a man who has built one of the greatest financial empires in human history by committing a single revolutionary act of heresy. Warren Buffett, the chairman and CEO of Berkshire Hathaway, has spent over 60 years proving that the primary job of an investor is not to predict the unpredictable. It is not to be an economist, a political pundit, or a market timer. The primary job of an investor, the only job that truly matters, is to correctly value a business. This is the final promise he offers, not the promise of a crystal ball, but the promise of a compass. A compass that allows you to navigate the storm of market sentiment and media hysteria by focusing on the one true north, the durable, long-term earning power of an individual enterprise. This is not just an investment strategy. It is a philosophy for achieving a state of mental freedom, a freedom from the noise that whipsaws the portfolios of the 99%. It is the secret to transforming yourself from a gambler betting on headlines into a business owner investing in value. And the first step on this path, the foundational principle upon which his entire empire is built, is a deceptively simple idea known as the circle of competence. The story that best illustrates this foundational pillar of the Buffett strategy unfolded not in a moment of brilliant insight, but during a period of intense public ridicule. The late 1990s were not kind to Warren Buffett. It was the height of the dot-com bubble, a euphoric, manic era where any company with a .com attached to its name saw its stock price launch into the stratosphere. It was a time when the old rules of business analysis were declared obsolete. Profits didn't matter. Cash flow was an archaic concept. All that mattered were eyeballs, clicks, and the promise of a new paradigm. As tech stocks like Cisco Systems, Intel, and Microsoft soared to unbelievable valuations, Berkshire Hathaway, with its portfolio of decidedly old economy businesses like insurance, furniture stores, and candy makers, began to lag the market badly. The financial media, once fawning over the Oracle of Omaha, turned on him with a vengeance. The crescendo came on December 27, 1999, when the influential financial magazine Barron's published a scathing cover story with the headline, "What's Wrong, Warren?" The article was brutal, portraying Buffett as a relic, a man whose folksy value investing approach was hopelessly out of touch with the new digital reality. They argued his refusal to invest in the technology stocks that were making everyone else rich was a sign that he had lost his touch, that his best days were behind him. The pressure was immense. His shareholders were questioning him. His peers in the world of wealth management were lapping him. Every fiber of social proof, every headline, every market signal was screaming at him to abandon his principles and join the party. But Buffett did not budge. He watched as companies with no revenue and no profits were given market capitalizations larger than established industrial giants. He attended Allen & Company's Sun Valley Conference, the exclusive retreat for media and tech moguls, and listened to the evangelists of the new economy. And his response was always the same, delivered with a calm, almost frustrating simplicity. I don't understand them. He would explain that he had no special insight into which search engine would dominate, which software company would build a lasting moat, or which fiber optic cable provider had a sustainable business model. He readily admitted his ignorance. He said, I don't want to play in a game where the other guy has an advantage. His advantage, his entire strategy, was built on his ability to understand the long-term competitive dynamics of a business. He could tell you with near certainty that people would be chewing Wrigley's gum or drinking Coca-Cola in 20 years. He could not say the same for Pets.com or GeoCities. He knew that the most important thing in investing was not to have a high IQ, but to have the intellectual discipline to define the perimeter of your own knowledge and to never ever stray beyond it. This was his circle of competence. And while the world mocked him for staying inside it, he knew that all the real danger, all the catastrophic mistakes, lay just outside its borders. Then the inevitable happened. In March of 2000, the bubble burst. The Nasdaq index, a proxy for the tech-heavy market, began a brutal, soul-crushing decline. It would ultimately fall nearly 80% from its peak. Companies that were once worth billions went bankrupt. Fortunes built on paper profits evaporated overnight. The new paradigm was revealed to be the same old speculative mania that has appeared countless times throughout history. And what of Warren Buffett, the man who was out of touch? As the tech darlings imploded, the solid, cash-generating businesses of Berkshire Hathaway chugged along. His portfolio, which had looked so foolish in 1999, now looked like an unassailable fortress. In the 2 years from March 2000 to March 2002, as the S&P 500 fell by more than 25%, Berkshire Hathaway's stock price rose. He hadn't predicted the crash. He never claimed to. He simply refused to participate in a game he didn't understand. He obeyed the single most important rule of his investment strategy: stick to what you know. His circle of competence had not made him look smart during the party, but it had saved him and his investors from the devastating hangover that followed. The profound power of this story lies in the psychological principle it so perfectly illustrates: the active and conscious overriding of the Dunning-Kruger effect and the bias of overconfidence. The Dunning-Kruger effect is a cognitive bias in which people with low ability at a task overestimate their ability. But its more dangerous corollary is that highly intelligent people often mistakenly assume their intelligence in one domain is transferable to all other domains. A brilliant surgeon might believe he's a brilliant stock picker. A successful entrepreneur in software might believe she can expertly value an oil and gas company. This is the intellectual arrogance that Buffett so studiously avoids. His genius is not in knowing everything, but in possessing a powerful sense of intellectual humility. He has what Charlie Munger calls metacognition, the ability to know the limits of his own knowledge. This is an incredibly rare trait. The human brain is wired for overconfidence. We are biologically incentivized to believe we are smarter and more capable than we truly are, as it historically gave us an edge in survival and social hierarchies. In the modern world of investing, however, this overconfidence is a catastrophic liability. It's what whispers in your ear. You've read a few articles about artificial intelligence. You should definitely invest your life savings in this obscure AI chip startup. It's the voice that says, sure, you don't know how biotechnology works, but this company's stock is going up, so it must be a good investment. Buffett's circle of competence is a mental firewall against this seductive and destructive internal monologue. It is the discipline to say, I don't know, and because I don't know, I will do nothing. This simple phrase is one of the most powerful wealth-protecting incantations an investor can possess. It short-circuits the brain's tendency to leap to conclusions and gamble on incomplete information, a core tenet of any sound investment strategy aimed at achieving financial freedom. So how can an ordinary retail investor, someone without Buffett's 60 years of experience, apply this mental model and build their own circle of competence? The process is a practical blueprint for intellectual honesty. The first step is to take out a piece of paper and create 3 lists. The first list is your professional expertise. What do you do for a living? If you are a software engineer, a doctor, a plumber, or a marketing executive, you possess a deep, ground-level understanding of a particular sector of the economy. You understand its jargon, its competitive landscape, its key players, and its future trends far better than a Wall Street analyst looking at a spreadsheet. This is the core of your circle. The second list is your genuine, deep-seated hobbies and interests. Are you a passionate gamer who understands the economics of video game publishers? Are you a car enthusiast who knows the difference between various auto manufacturers, brand strengths, and weaknesses? Are you a home cook who intuitively understands the power of a consumer packaged goods brand? These are areas where you have put in the 10,000 hours of learning for sheer pleasure. This is fertile ground for investment ideas. The third list is comprised of industries you have made a deliberate, long-term effort to study, even if they aren't related to your job or hobbies. Perhaps you've spent years reading about the railroad industry or the insurance business. Be honest about the depth of your knowledge. Once you have these lists, you have a map of your personal circle of competence. The second and most crucial step is the application of a powerful filter. For any potential investment that you consider, you must ask yourself a single, uncompromising question. Could I stand in front of a classroom of intelligent high school students and explain the long-term competitive dynamics of this business, and why it will be successful for the next 10 years, for 1 hour, with no notes? If the answer is anything less than an immediate and confident yes, you must discard the idea. This is not a test of your intelligence. It is a test of your comprehension. It forces you to distinguish between a superficial familiarity with a company's name or product and a deep, fundamental analysis of its business model. Can you explain its pricing power, its supply chain, its customer acquisition costs, its corporate culture, and the specific reasons it is better than its competitors? If you can't, you have no business owning it. Because when the stock price inevitably drops 30% on some scary macroeconomic news, you will have no foundation of conviction to stand on. You will panic and sell, precisely at the worst moment. This blueprint, this simple test, is the mechanism that transforms you from a speculator into an intelligent investor. To truly appreciate the power of this approach, we must examine its antithesis, the path walked by the 99% of investors. This is the path of the hot tip chaser, the trend follower. Their journey begins not with quiet study, but with the siren song of excitement and the fear of missing out, or FOMO. They might be at a cocktail party and hear their brother-in-law, who knows nothing about finance, rave about a new cryptocurrency that's, quote, going to the moon. Or they'll see a segment on a financial news channel about a revolutionary gene-editing technology and decide they need to be a part of it. They feel a powerful urge to participate in the story, to own a piece of the future. The problem is, their research consists of reading a few news articles and looking at a rising stock chart. They have absolutely zero understanding of the underlying business, the technology, or the competitive landscape. They are well outside their circle of competence, but their overconfidence bias tells them that because they are smart in their own field, they can easily master this one too. They buy the stock, usually after it has already seen a significant run-up. For a while, they feel like a genius as the price continues to climb. But then, the story changes. A competitor emerges. A clinical trial fails. The market sentiment shifts. The stock begins to fall. Now they are faced with a terrible dilemma. Is this a temporary setback, a chance to buy more at a discount, or is it the beginning of the end? Because they never understood the business in the first place, they have no way to answer this question. They have no anchor of intrinsic value to hold onto. All they see is the red on their screen and the mounting feeling of panic. Their initial FOMO transforms into a desperate fear of further loss. And so, they do what the vast majority of people in this situation do. They sell, often near the bottom, locking in their losses and vowing never to touch that risky sector again. This cycle of euphoric buying and panic selling is the engine that transfers wealth from the impatient to the patient, from the speculator to the business owner. The direct financial connection between adhering to your circle of competence and superior long-term returns is profound and multifaceted. Firstly, it dramatically reduces the number of unforced errors you make. The biggest losses in investing don't come from small mistakes. They come from catastrophic bets on things you don't understand. By staying within your circle, you eliminate the single greatest risk in your portfolio, your own ignorance. Secondly, it fosters the kind of concentration that is necessary for significant portfolio growth. Instead of owning 100 different stocks you barely know, you might own 10 businesses you understand inside and out. This allows your best ideas to have a meaningful impact on your net worth. It's a core principle of high-end wealth management. Thirdly, it transforms your psychological relationship with market volatility. When you own a business you understand, a 30% price drop is not a source of panic. It is a source of excitement. It's an opportunity to buy more of a wonderful business at a cheaper price. Buffett demonstrated this time and again. This mindset shift is the key to turning market fear to your advantage, a critical skill for beating the market. Ultimately, the circle of competence isn't just a defensive tool, it's an offensive weapon. It allows you to wait patiently for the fat pitch, the rare, obvious opportunity that falls squarely in your area of expertise. And when that pitch comes, because you have such a deep understanding, you have the confidence to swing for the fences, to make a large, decisive bet that can be life-changing. This is how real, lasting wealth is built, leading directly to that coveted state of financial independence. It is the bedrock of the entire Buffett philosophy, the starting point for learning to ignore the noise and focus on what truly matters. Once an investor has committed to operating solely within their circle of competence, a second, more profound mental shift must occur. It is the transition from thinking like a stock trader to thinking like a business owner. This is not a semantic difference. It is a fundamental re-engineering of one's entire perception of the market. To the trader, a stock is a ticker symbol, a flickering blip on a screen that moves up and down. It is an abstract concept to be bought and sold based on chart patterns, momentum, or the latest news catalyst. To the business owner, a stock is a fractional ownership interest in a tangible, living, breathing enterprise. It is a company with employees, factories, brands, customers, and a long-term economic trajectory. This shift from the abstract to the concrete is the key that unlocks the ability to correctly value a business, which is the core directive of the entire Buffett methodology. And no story captures this mindset more perfectly than Buffett and Munger's acquisition of a simple, beloved chocolate company, See's Candies. In 1972, Warren Buffett and his partner Charlie Munger were presented with an opportunity to buy See's Candies, a family-owned California-based chocolate maker, for $30 million. From the perspective of a conventional Wall Street analyst at the time, the deal looked mediocre at best. The company had tangible assets, factories, stores, inventory, worth only about $8 million. Paying $30 million meant paying a huge premium over its book value. It also required very little capital to operate, which sounded good, but meant there weren't many opportunities to reinvest profits back into the business for high rates of growth. A trader looking at the numbers on a page might have dismissed it as a slow-growing, overpriced cigar butt investment. But Buffett and Munger weren't looking at it as traders, they were looking at it as potential business owners. They did their homework. They saw a company that had an almost fanatical brand loyalty, especially in California. For generations, giving a box of See's Candies for Valentine's Day, Christmas, or a birthday was a deeply ingrained social ritual. This brand loyalty gave the business something truly magical: pricing power. Each year, the managers of See's could raise the price of their chocolates, and customers would barely flinch. They weren't just buying chocolate. They were buying nostalgia, quality, and tradition. The cost of the product was a small part of the emotional transaction. Buffett and Munger realized they weren't just buying $8 million of physical assets. They were buying an intangible asset of immense value, a powerful brand that resided in the minds of millions of customers. This mental real estate didn't show up on the balance sheet, but it was the source of the company's incredible economic power. It was a durable competitive advantage, an economic moat that protected it from competitors. They haggled the price down to $25 million and bought the entire company. That purchase proved to be a watershed moment for Berkshire Hathaway. See's Candies became the prototype for the kind of business they would seek to own for the next 5 decades. It was a business they understood, with a simple product and a powerful, lasting moat. And the financial results have been nothing short of staggering. Since that $25 million purchase in 1972, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway. All of that cash flow, year after year, has been sent back to Omaha to be redeployed into other investments. It became a gusher of capital that funded countless other acquisitions. Buffett didn't buy See's because he had a forecast about the 1973 economy or interest rates. He bought it because he understood the business and knew that people in California would be eating those chocolates for decades to come. He wasn't buying a stock, he was buying a business. This is the essence of the business owner mindset. This dramatic shift in perspective is rooted in a powerful psychological principle known as the framing effect. The framing effect is a cognitive bias where people decide on options based on whether the options are presented with positive or negative connotations, for example, as a loss or as a gain. More broadly, the way information is framed has a massive impact on our decision-making. The entire infrastructure of the stock market, the ticker tape, the flashing red and green lights, the 24/7 news cycle discussing daily price movements, is a frame. It frames stocks as abstract, volatile instruments for speculation. It encourages you to think, what is this stock going to do today, this week, this month? This frame naturally leads to short-term emotional decision-making. The business owner mindset is a conscious act of reframing. It shatters the market's frame and replaces it with your own. You are no longer looking at a ticker symbol. You are looking at a business. This new frame forces you to ask a completely different set of questions. Instead of, where is the stock price going, you ask, where is the business's earning power going over the next 10 years? Instead of, is this a good time to buy, you ask, is this a good price to pay for this business? This cognitive shift from the abstract world of stock charts to the concrete world of business operations is what allows for rational, long-term capital allocation. It insulates you from the manic-depressive swings of the market because your focus is on the underlying reality of the enterprise, not the fleeting sentiment of the crowd. It is a mental discipline that is essential for anyone aspiring to a CEO mindset in their personal financial management. How, then, can an individual investor practically apply this mindset? The blueprint is a powerful thought experiment that you must conduct before buying a single share of any company. It's called the Buy the Whole Company test. Before you invest even $100, you must ask yourself the following question. If I had the total market capitalization of this company in cash, would I be willing to buy the entire business today, lock it away, and not be able to sell it for at least 10 years? For example, if you are considering buying shares in Apple, you must ask, if I had $3 trillion, would I buy all of Apple Inc. right now? This question is a powerful filter because it immediately forces you out of the trader's mindset and into the owner's mindset. It compels you to consider the things a real business owner would. You would have to think about the quality of the management team. Are Tim Cook and his lieutenants the right people to steer this ship for the next decade? You'd have to analyze its competitive advantages. Is the Apple ecosystem, the brand, the switching costs, a durable moat that can fend off competitors? You would have to forecast its long-term earnings power. Will people still be buying iPhones and using Apple services in 2035? What are the biggest risks to that earnings stream? You would have to assess the price. Is $3 trillion a fair price to pay for those future earnings? By forcing yourself to answer these difficult, long-term questions, you completely change the basis of your decision. The daily stock quote becomes irrelevant. The latest analyst upgrade or downgrade becomes meaningless noise. Your decision rests on a solid foundation of business analysis, not on the shifting sands of market sentiment. If you are not willing to hypothetically own the entire business for a decade, you have no business owning a small piece of it for 10 minutes. The antithesis of this disciplined approach is the path of the 99%, the path of the ticker symbol gambler. This individual lives and dies by the flickering screen. Their world is not one of business fundamentals, but of technical analysis, chart patterns, and market chatter. They speak a language of moving averages, resistance levels, and breakouts. They see stocks not as ownership stakes in businesses, but as horses in a race. Their goal is not to participate in the long-term value creation of a company, but to guess which horse will run fastest in the next lap. They are constantly searching for a catalyst, an upcoming earnings report, a new product announcement, a Fed meeting that they believe will cause the stock's price to jump. Their holding period is measured in days or weeks, not years or decades. They are utterly consumed by the noise that Buffett studiously ignores. This approach is intoxicating because it offers the illusion of control and the thrill of action. But it is a brutal, unforgiving game. The ticker symbol gambler is constantly being whipsawed by market volatility. They buy on greed after a stock has already run up, and they sell on fear after it has fallen. They are perpetually paying transaction costs and short-term capital gains taxes, which act as a powerful anchor on their returns. Their emotional state is a roller coaster, tied directly to the minute-by-minute fluctuations of their portfolio. They are not investing, they are gambling. And in the long run, the house, represented by the patient, business-focused investor, always wins. This frantic activity is the polar opposite of a sound investment strategy for portfolio growth. The direct financial connection of the business owner mindset is that it forces you to focus on the metric that truly matters: owner earnings. Wall Street and the financial media are obsessed with quarterly earnings per share, or EPS. But Buffett has long argued that this is a flawed and often misleading figure, subject to accounting manipulations. He prefers to calculate what he calls owner earnings. The formula is simple. Owner earnings equals a company's net income plus non-cash charges like depreciation and amortization, minus the average annual amount of capital expenditures required to maintain the business's long-term competitive position and unit volume. In simpler terms, it's the real cash that a business generates that is truly available to the owners. It's the cash you could theoretically take out of the business each year without harming its operations. By focusing on this metric, you are looking at the business the way a private owner would. You are asking, how much cash is this enterprise putting in my pocket? This is a much more honest and conservative measure of a company's true economic performance than reported EPS. When you begin to value companies based on their long-term owner earnings, your entire asset allocation strategy changes. You become less interested in speculative growth stories with no profits and more interested in durable, cash-generating machines, even if they are boring. This focus on real cash flow is the mathematical engine that drives superior long-term capital gains. It's how you build a portfolio that produces a steady stream of wealth, independent of the market's daily moods, paving the way for true financial independence. Once an investor has established their circle of competence and adopted the mindset of a business owner, they must confront the greatest obstacle to long-term success: their own emotions, amplified and manipulated by the ceaseless roar of the market. The market is not a logical, calculating machine. It is a vast, chaotic amalgamation of human hopes and fears. To navigate it successfully requires not just intellectual rigor, but profound emotional discipline. Warren Buffett's most brilliant teaching tool for achieving this discipline is not a complex formula, but a simple parable: the story of your manic-depressive business partner, Mr. Market. This mental model is the key to achieving the emotional detachment necessary to ignore the cacophony of economic predictions and focus solely on business value. And never was Buffett's mastery of this principle more evident or more profitable than during the darkest days of the 2008 financial crisis. As the autumn of 2008 unfolded, the global financial system teetered on the brink of collapse. Lehman Brothers had filed for bankruptcy, sending shockwaves through the credit markets. Giants of American finance like AIG, Goldman Sachs, and Morgan Stanley were either failing or rumored to be next. The stock market was in a state of freefall. Fear was palpable. The news was a relentless fire hose of apocalyptic headlines predicting a second Great Depression. The prevailing narrative, trumpeted by experts on every channel, was that the very foundation of capitalism was crumbling. For the average investor, this was a time of pure terror. People were pulling their money out of the market at a record pace, selling everything at fire sale prices, desperate to preserve what little capital they had left. The emotional impulse to flee was overwhelming. In this moment of maximum panic, Warren Buffett did the exact opposite. On September 23, 2008, he announced that Berkshire Hathaway would invest $5 billion in Goldman Sachs, one of the epicenters of the crisis. A few weeks later, he penned an op-ed for the New York Times titled, "Buy American, I Am," in which he stated he was moving his personal cash reserves into U.S. stocks. The following year, he would make a similar multi-billion-dollar investment in Bank of America. What did Buffett see that everyone else missed? He didn't have a crystal ball. He didn't know if the market would go down another 10, 20, or even 50%. He wasn't making a macroeconomic prediction that the recession would end on a specific date. He was simply applying his parable of Mr. Market. He viewed the market not as a source of information but as a source of opportunity. In his mind, Mr. Market had shown up at his door, gibbering with fear, offering to sell him pieces of America's finest financial institutions at ludicrously low prices. While others saw Goldman Sachs as a toxic asset on the verge of collapse, Buffett saw a powerful, century-old franchise, with deep client relationships and immense intellectual capital that was being offered at a price that made no sense in the long run. He was able to completely detach from the prevailing emotional hysteria and focus only on one thing: the long-term value of the business versus the price being offered. The terms of his deal were extraordinary. He received preferred stock paying a 10% dividend, a massive return in a world where interest rates were heading to zero. He also received warrants, giving him the right to buy Goldman Sachs common stock at a fixed price for years to come. It was a deal he could only get because of the extreme fear in the market. He was not being brave, he was being rational. He was following his most famous piece of advice: be fearful when others are greedy, and greedy only when others are fearful. He was using Mr. Market's panic as his opportunity, a masterclass in emotional control that would net Berkshire Hathaway billions in profits. The psychological principles that Buffett was exploiting in this instance are two of the most powerful and primitive biases hardwired into the human brain: loss aversion and herd behavior. Loss aversion, a concept pioneered by psychologists Daniel Kahneman and Amos Tversky, describes the fact that for most people, the psychological pain of losing a dollar is roughly twice as powerful as the pleasure of gaining a dollar. This asymmetry means we are evolutionarily programmed to be risk-averse, especially when faced with the prospect of immediate losses. During a market crash, loss aversion kicks into overdrive, screaming at us to sell now and make the pain stop. This impulse is then magnified exponentially by herd behavior, also known as social proof. As human beings, we are social creatures who survived for millennia by sticking with the tribe. If everyone in the tribe was running from a tiger, it was a very bad idea to stand still and analyze the situation. Our instinct is to run first and ask questions later. In the stock market, this instinct is a death sentence. When everyone else is panic selling, our herd instinct tells us they must know something we don't, and we should sell too. This combination of loss aversion and herd behavior is what creates the waterfall declines and capitulation bottoms of bear markets. Buffett's parable of Mr. Market is a cognitive therapy tool designed to short-circuit these primal instincts. By personifying the market as a single, irrational, manic-depressive individual, he depersonalizes the threat. Mr. Market is not an all-knowing God passing judgment on your portfolio. He's just a crazy business partner. You are under no obligation to act on his ravings. This mental separation creates the emotional distance required to act rationally when everyone around you is losing their minds. The applied mental model here is what we can call the servant not a guide framework. It's a daily practice for managing your relationship with the market. Step 1. Every morning explicitly visualize Mr. Market. Picture him as a real person, your business partner in every stock you own. He's moody, erratic, and his opinions change on a dime based on the morning headlines. Step 2. Every day, this partner comes to you and does two things. He quotes you a price at which he's willing to buy your shares from you, and a price at which he's willing to sell you his shares. Sometimes his prices are sensible. But often, on days of extreme news, his prices are completely unhinged from the underlying reality of the business. Step 3, the crucial step. Your job is to remember that his purpose is to serve you, not to guide you. His quotes are not instructions. His mood is not information about the business. It is just noise. Your only job is to compare his offered price to your own, independently calculated estimate of the business's intrinsic value. Step 4. You act only when it is to your extreme advantage. If Mr. Market is in a state of wild euphoria and offers to buy your shares for far more than you think they are worth, you should consider selling to him. If he is in the depths of a suicidal depression and offers to sell you his shares for a fraction of their true worth, as he did in 2008, you should greedily buy from him. On all other days when his prices are reasonable or unappealing, your job is to politely ignore him and go about your day, focusing on the performance of your businesses. This simple daily mental exercise builds the muscle of emotional detachment. It is the core practice of the intelligent investor, turning market volatility from a source of fear into a source of opportunity. The antithesis of this disciplined framework is the headline investor. This individual's portfolio is a direct, near-instantaneous reflection of the last 24 hours of media coverage. Their investment process begins and ends with the news. They wake up, check their phone, and see a headline. Fed chairman signals possible interest rate hike. Their brain immediately jumps to a conclusion. Rate hikes are bad for stocks. They log into their brokerage account and sell. The next day, the headline reads, "Unexpectedly strong jobs report released." Their brain concludes, a strong economy is good for stocks. They log in and buy back what they just sold. They are a puppet, and the financial media is the puppeteer, pulling their strings with every breaking news alert. They believe they are being informed and responsive, but in reality, they are engaging in a futile and costly game of trying to outguess the collective sentiment of millions of other people who are reading the exact same headlines. Their portfolio is churned into dust by constant trading, transaction fees, and the taxes generated by their frenetic activity. They live in a state of perpetual anxiety, their financial well-being held hostage by the next news cycle. This is the definition of being whipsawed, and it is the guaranteed path to underperformance. It is the complete abdication of the CEO mindset, which demands independent thought and a long-term perspective. The direct financial connection of mastering your emotions is the ability to systematically exploit volatility for profit. The 99% of investors view market volatility as synonymous with risk. To them, a plunging stock price is a loss. But to the disciplined, business-focused investor who has mastered the Mr. Market parable, volatility is the greatest opportunity the market provides. Risk is not a fluctuating stock price. Risk is the possibility of a permanent loss of capital, which happens when you overpay for a business or buy something you don't understand. Volatility, on the other hand, is merely the symptom of Mr. Market's mood swings. By having a firm, well-researched opinion on the intrinsic value of your businesses, you can use these mood swings to your advantage. A market crash driven by macroeconomic fears becomes a system-wide sale. It allows you to acquire shares in wonderful businesses at discounted prices, dramatically lowering your average cost basis. This single action, buying low when others are panic selling, has a more powerful positive impact on long-term capital gains than almost any other investment decision you can make. It is the financial manifestation of being greedy when others are fearful. A portfolio built this way, with a cost basis established during periods of panic, will have a massive, built-in tailwind for future growth. This is the cornerstone of sophisticated wealth management and the engine that powers the journey to financial freedom. It is not about predicting the news. It is about profiting from how others react to it. Having fortified one's mind against the emotional turmoil of the market, the serious investor is faced with a practical question. If not from the news, the experts, or the market's price action, where does the information needed to value a business actually come from? The answer lies in a practice that is at the heart of Buffett's analytical process, a method of deep, independent research he learned from the father of value investing, Benjamin Graham, and perfected over decades. It's a folksy term for a powerful idea, the scuttlebutt method. Popularized by the legendary investor Philip Fisher, scuttlebutt is the art of going beyond the official financial statements and analyst reports to develop a rich, qualitative, ground-level understanding of a business. It is about talking to customers, competitors, former employees, and suppliers to uncover the real story. And no event in Buffett's early career demonstrates the immense power of this technique more than his investment in American Express during the infamous salad oil scandal. In November of 1963, the financial world was rocked by a bizarre and devastating corporate fraud. Allied Crude Vegetable Oil, a company run by a New Jersey-based swindler named Tino DeAngelis, was a major customer of American Express's warehousing division. Allied Crude had taken out massive loans using its inventory of salad oil as collateral, with American Express certifying the existence of that inventory. But when Allied defaulted, the horrifying truth was revealed. The giant tanks supposedly full of valuable salad oil were mostly full of seawater, with only a thin layer of oil floating on top. The fraud was colossal, and American Express, having guaranteed the non-existent collateral, was on the hook for what amounted to $60 million, a massive sum that threatened to wipe out a significant portion of the company's net worth. Wall Street panicked. The story was a nightmare headline, combining fraud, incompetence, and massive potential losses. Analysts and experts predicted bankruptcy. The stock of American Express plummeted by more than 50% in a matter of weeks as terrified investors dumped their shares. The consensus view, the view of the entire expert class, was that American Express was finished. But Warren Buffett, then a young, relatively unknown fund manager in Omaha, was skeptical of the consensus. He refused to take the headlines at face value. Instead of reading Wall Street research, he began his own scuttlebutt investigation. He wasn't an expert in warehousing regulations or oil futures, so he focused on what he could understand, the core businesses of American Express. He went to his local Omaha banks and restaurants. He talked to the tellers and the managers. He asked them if they were seeing any change in how people were using American Express travelers' checks. They all said no. Business was as brisk as ever. He talked to friends and acquaintances who used the American Express credit card, a relatively new product at the time. He found that their loyalty was unshaken. They weren't going to stop using their card because of a scandal in a division they'd never even heard of. He observed people at restaurants and shops paying with their little green cards and saw that the brand's prestige was intact. Through this simple, on-the-ground research, Buffett reached a powerful conclusion. The scandal, while financially painful, had done nothing to damage the company's two primary economic engines, the traveler's check and the credit card. The company's powerful moat, its brand, and the trust it commanded with consumers, was completely unharmed. He realized that Mr. Market, in his panic over the salad oil headline, was offering him the entire, magnificent American Express franchise for a price that failed to account for the enduring strength of its core operations. Convinced by his scuttlebutt research, he made a bold move, investing 40% of his entire investment partnership's capital into American Express stock. It became his single largest investment, and over the next few years, as the company weathered the scandal and its core businesses continued to thrive, the stock price soared, netting his investors a fortune. He hadn't predicted the outcome of the lawsuits. He had understood the reality of the business. This story is a perfect illustration of how to combat two insidious cognitive biases that plague the average investor: the anchoring bias and the availability heuristic. The anchoring bias is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. For investors in 1963, the anchor was the headline: "Massive fraud at American Express." All subsequent information was viewed through the lens of that terrifying anchor, leading them to overweight the negative news. The availability heuristic is a mental shortcut that relies on immediate examples that come to a given person's mind when evaluating a specific topic. The most recent dramatic and emotionally charged information, in this case the salad oil scandal, is the most available in our minds, and we therefore give it more importance than it deserves. Buffett's scuttlebutt method is a deliberate, systematic process for fighting these biases. It is an active search for disconfirming evidence. While Wall Street was anchored to the scandal and the availability of negative news, Buffett actively sought out primary, real-world information that challenged the consensus narrative. He went looking for data on the health of the credit card and traveler's check businesses and found it to be robust. This discipline of seeking out information that lies beyond the readily available headlines is what separates the great investor from the amateur. It is the hard work of forming an independent opinion. So how can a modern retail investor, without Buffett's network or resources, apply the scuttlebutt method? The blueprint for a modern scuttlebutt investigation is about being a detective of business reality. First, you must go beyond the standard financial documents like the 10K. While essential, they only tell part of the story. Read the industry's trade journals. If you're interested in a semiconductor company, read Semiconductor Engineering, not just the Wall Street Journal. Trade journals give you the unvarnished perspective of the people who live and breathe that industry every day. Second, talk to people, carefully and ethically. If you're analyzing a retail company like Target, visit their stores. Visit their competitors' stores, like Walmart. Observe the customer experience. How long are the checkout lines? Are the shelves well stocked? How helpful are the employees? Observe the customers. What are they buying? Do they seem happy? This is real, qualitative data that you will never find in an annual report. Third, become a customer yourself. Use the product or service extensively. Experience its strengths and its weaknesses firsthand. If you're analyzing Apple, you should use an iPhone. If you're analyzing Netflix, you should be a subscriber. This gives you an intuitive feel for the company's value proposition that is invaluable. Fourth, analyze the competition with the same rigor. Why would a customer choose a competitor's product over the one you are analyzing? Be brutally honest. Understanding the competitive landscape is crucial to assessing the durability of a company's moat. This process of methodical, on-the-ground research builds a deep, multifaceted understanding of a business. It is the only way to build the conviction necessary to hold on during a market downturn. It is the essence of true fundamental analysis. The antithesis of this deep, independent work is the analyst report follower. This is the investor who completely outsources their thinking to the so-called experts on Wall Street. Their investment process consists of screening for stocks that have a strong buy rating from a major investment bank like Goldman Sachs or Morgan Stanley. They might read the analyst's summary report, but they rarely, if ever, do any independent verification of the claims. They are essentially trusting a stranger with their capital, a stranger whose incentives may not be aligned with their own. The problem with this approach is that it creates a complete lack of conviction. When you buy a stock based on someone else's opinion, you have no intellectual ownership of the decision. So when the stock price falls, as all stock prices do from time to time, you are left in a state of confusion and fear. Was the analyst wrong? Has the story changed? Is this a buying opportunity or a signal to get out? Because you did none of the original work, you have no way to answer these questions. Your only recourse is to look for a new report from another analyst, hoping they will tell you what to do. This investor is perpetually dependent, always reacting, and never in control. They have abdicated their responsibility as a capital allocator and become a mere follower of financial fashion, a path that rarely leads to the financial independence they seek. The direct financial connection of the scuttlebutt method is that it can create a genuine information arbitrage for the diligent individual investor. In the age of high-frequency trading and instant information, many believe the market is perfectly efficient and that there's no edge to be had. This is true for 99% of information. But the deep, qualitative, scuttlebutt-style information about a company's culture, product quality, and customer loyalty is not easily quantifiable and is often missed by Wall Street analysts who are chained to their desks, building complex financial models. By doing the legwork, you can gain a genuine analytical edge. You can learn things about a business that the market doesn't yet appreciate. This information advantage allows you to identify truly undervalued assets before the rest of the market catches on. The American Express scandal was a perfect example. The market was pricing the company for bankruptcy based on the available headline news. Buffett's scuttlebutt research gave him an informational edge. He knew the core franchise was healthy. This edge translated directly into one of the most successful investments of his career. For the retail investor today, this same principle applies. The hard work of fundamental analysis and scuttlebutt research is how you tilt the odds in your favor. It's how you move beyond simply playing the market to systematically beating the market, creating the kind of portfolio growth that builds real, lasting wealth. We arrive now at the final pillar, the capstone that locks all the other principles into an unbreakable structure of discipline and focus. After learning to stay within your circle of competence, adopt a business owner's mindset, master your emotions, and conduct deep independent research, you need a powerful filtering mechanism to ensure that these skills are applied only to the most extraordinary opportunities. Warren Buffett provides this with another elegant and potent mental model, the 20-slot punch card. It is the ultimate antidote to the frenetic, hyperactive trading that destroys so much investor capital. It is a philosophy that forces extreme selectivity, patience, and a long-term perspective, transforming your entire approach to capital allocation and executive decision-making. And its spirit is perfectly embodied in one of the biggest and boldest investments of Buffett's entire career, the acquisition of the Burlington Northern Santa Fe Railway. In late 2009, in the lingering shadow of the great financial crisis, Warren Buffett announced that Berkshire Hathaway would acquire the entirety of the BNSF Railway for $44 billion, the largest acquisition in the company's history. On the surface, it seemed like a strange move. Railroads were the epitome of the old economy, capital-intensive, slow-growing, and heavily regulated. But this was not a short-term trade. This was Buffett using one of his precious lifetime punches. He called the investment an all-in wager on the economic future of the United States. He wasn't betting on the next quarter's GDP report or the next year's corporate profits. He was making a bet on the next 100 years. He understood that a transcontinental railroad is an irreplaceable asset. You could not replicate BNSF's network of tracks today. The cost and regulatory hurdles would be insurmountable. It is, in effect, a toll bridge for the American economy. As long as the U.S. economy grows over the long term, more goods will need to be moved from coast to coast, and BNSF will be there to move them, taking a small slice of that economic activity. It was a business with a moat as wide and deep as the country itself. This decision reflects the punch card philosophy perfectly. The mental model is this. Imagine that at the beginning of your investment life, you are handed a punch card with only 20 slots on it. These 20 punches represent the total number of investment decisions you are allowed to make in your entire lifetime. Every time you buy a stock, you must use up one of those precious slots. Once all 20 are punched, you can make no more changes. This simple but profound constraint completely revolutionizes your decision-making process. The question is no longer, is this stock a good buy for the next 6 months? The question becomes, is this business so wonderful, its long-term prospects so clear, and the price so attractive that I am willing to commit 1/20th of my entire lifetime allotment of investment decisions to it? This immediately filters out 99% of the ideas that cross your desk. It kills the urge to speculate on hot tips, to trade on rumors, or to buy mediocre companies just because they seem cheap. It forces you to wait, patiently, for the truly exceptional opportunities, the BNSFs of the world. It compels you to do the deep scuttlebutt research required because the cost of being wrong is so high. You wouldn't waste a punch on something you didn't understand inside and out. It is the ultimate tool for enforcing discipline and focus. The underlying psychological principle at play here is the deliberate manufacturing of scarcity to combat the paradox of choice and decision fatigue. The paradox of choice is the modern phenomenon where having an abundance of options actually leads to anxiety, paralysis, and poorer decisions. When an investor can choose from thousands of stocks, ETFs, and mutual funds, the sheer volume of choice is overwhelming. This often leads to either inaction or, worse, frenetic, thoughtless activity. A little bit of this, a little bit of that. Decision fatigue is the related concept that the quality of our decisions deteriorates after a long session of making them. The 20-slot punch card is a brilliant cognitive tool that solves both problems. By artificially creating extreme scarcity, only 20 choices for life, it makes each decision profoundly meaningful. It removes the anxiety of infinite options and replaces it with the clarity of a single, high-stakes question. Is this worthy of a punch? This forces you to conserve your mental energy and your capital for the few decisions that truly matter. It shifts your entire mindset from being a hyperactive trader to being a patient, deliberate capital allocator, the true CEO mindset. It's a framework for making a few great decisions and then letting the power of long-term compounding do the heavy lifting, a core principle for achieving financial freedom. To apply this powerful mental model, you need to make it a tangible part of your investment process. The blueprint is simple but not easy. Step 1. Get a physical index card and draw 20 circles on it. This is your punch card. Place it on your desk, next to your computer. Make it a physical reminder of your commitment to this philosophy. Step 2. Before you even consider making an investment, you must complete all the prior steps. Is the idea within your circle of competence? Have you analyzed it from a business owner's perspective? Have you done the deep scuttlebutt research? Is the price attractive because Mr. Market is pessimistic? Only if an idea passes all these filters can it even be considered for a punch. Step 3. Before you click the buy button, you must perform a final mental check. Look at your card. Look at the empty slots. Ask yourself, one last time, is this truly one of the 20 best investment ideas I will have in my entire life? This is not about being right on every single pick. Some will inevitably not work out. It is about the quality of the process and the discipline of the filter. You will find that this constraint makes you a dramatically better investor. You will trade less, think more, and your research will become far more rigorous. It forces you to concentrate your capital in your highest conviction ideas, which is the mathematical key to building serious wealth. The antithesis of this focused approach is the path of the 99%, the path of the diversification investor. This term was coined by the legendary fund manager Peter Lynch to describe the all-too-common practice of buying so many different things that your portfolio becomes an unfocused, watered-down mess. This investor operates under the mistaken belief that owning hundreds of different stocks, funds, and assets is the definition of safety. They buy a little of this tech ETF, a little of that international fund, a few shares of a dozen different blue-chip companies, and maybe some speculative small caps for excitement. They are constantly tinkering, adding new positions, and selling others. The result of this hyperactivity is a portfolio that is complex, expensive, and ultimately ineffective. They have created their own personal index fund, but one that is burdened by high transaction costs, tax inefficiencies, and the lingering presence of their worst ideas, which act as a drag on the performance of their best ones. Their asset allocation is not a deliberate strategy. It is a chaotic collection of past whims and hot tips. They have a portfolio of hope, not a portfolio of conviction. They have mistaken activity for progress and diversification for safety, when in reality, as Buffett has said, wide diversification is only required when investors do not understand what they are doing. The direct financial connection of the 20-slot punch card philosophy is its power to unlock the explosive force of intelligent concentration. The great fortunes of finance and business were not built through timid diversification. Andrew Carnegie did not build his steel empire by diversifying into textiles and railroads. Bill Gates did not build Microsoft by hedging his bets with investments in soda companies. And Warren Buffett did not build Berkshire Hathaway by owning 500 different stocks. They built their fortunes by making large, concentrated bets on businesses they understood intimately. The mathematics of portfolio growth are stark. If you have a portfolio of 100 stocks and one of them doubles, your overall portfolio only increases by 1%. It barely moves the needle. But if you have a portfolio of only 10 stocks and one of them doubles, your overall portfolio increases by a full 10%. That is a life-changing difference. The punch card philosophy forces you into this kind of intelligent concentration. It gives you the courage, born of deep research and conviction, to make meaningful bets on your best ideas. This is the fast track to building wealth and achieving significant capital gains. It is the final crucial step in the journey from a retail investor tossed about by the whims of the market to a disciplined capital allocator in complete control of their financial destiny. It is the ultimate expression of focusing only on what matters. You have just journeyed through the core of Warren Buffett's operating system, a mental arsenal designed to achieve one primary objective: to liberate you from the noise and chaos of the financial world. You now possess the blueprint. You understand the necessity of a circle of competence, the power of a business owner's mindset, the emotional discipline to treat Mr. Market as your servant, the analytical edge of scuttlebutt research, and the clarifying focus of the 20-slot punch card. This is not just a collection of tips, it is a complete framework for making rational, intelligent decisions in an irrational world. You have invested your time to acquire a tool that can fundamentally change your financial future, a tool that can protect your capital and your peace of mind from the siren song of useless predictions and media hysteria. But what you have mastered today is, in essence, the most powerful defensive strategy in the world of finance. You have built an impenetrable fortress around your capital, protecting it from your own worst impulses and the madness of the crowd. This is a monumental achievement. However, a fortress, no matter how strong, is still just a fortress. It protects, but it does not expand. This framework is one half of the equation, the critical half that prevents catastrophic loss, but it is interconnected with another, equally powerful set of principles: the offensive strategy. The principles that explain not just how Buffett protects his capital, but how he compounds it at such an extraordinary rate, year after year, decade after decade. You have learned how to filter for quality, but the next piece of the map reveals the engine of growth. The video that is now on your screen is not just another video. It is the missing link. It is the bridge from defense to offense, from capital preservation to exponential capital growth. It takes the highly concentrated capital that your new filtering system has identified and plugs it into the compounding machine. It answers the next logical question. Once you have identified one of the 20 greatest businesses of your lifetime, what happens next? How do you think about its growth, its management, and the reinvestment of its earnings to create the cascading effect that builds true generational wealth? The principles you've just learned are the shield. What is on your screen now is the sword. One is incomplete without the other. You have proven that you are not a headline-chasing gambler. You are an analyst, a business owner, a disciplined allocator of your own capital. You have ascended to a new level of thinking. But the journey to a complete CEO mindset requires mastery of both sides of the coin. The choice to continue that ascent, to complete your mental arsenal by connecting this powerful filter to the engine of compounding, is yours. The next piece of the map is waiting.